All right, let's jump right in. Now, I'm willing to bet you've got one of their products sitting in your kitchen cabinet right this second. We're talking about Orkla India, the giant behind MTR and Eastern. And guess what? They're about to launch a huge IPO. So let's break down everything you need to know to figure out if this is an investment for you.
So, their spices, right? MTR's breakfast mixes, Eastern spice powders, they're everywhere. And that kind of brand recognition, it's incredibly powerful. But, and this is the big question for us as investors, does a brand you love in your kitchen automatically translate to a stock you should love in your portfolio? Well, that's exactly what we're here to figure out.
So, let's start with the basics. Who exactly is Orkla India? Well, first off, they're the Indian subsidiary of a huge Norwegian company called Orkla ASA. But here in India, you know them as the powerhouse behind two iconic brands, MTR and Eastern. We're talking about one of the biggest packaged food companies in the country. And get this for scale. They sell about 2.3 million units every single day. Just let that sink in for a moment.
All right, so how do they manage to sell so much? Let's get into the business of flavor and see where the money's really coming from.
Okay, so if you break down their revenue, the picture is pretty simple and honestly quite telling. Spices are the absolute core of their business, making up a whopping 2/3 of their total sales. The other third, that comes from convenience foods, things like breakfast mixes and ready-to-eat meals. Now, this heavy focus on the spice market is, well, it's a really critical piece of the puzzle here, and it has its pros and cons.
And this is where their strategy really shines. It's basically a tale of two regional kings. You've got MTR, which just completely dominates Karnataka with over a 31% market share. They're famous for their blended spices and those ready-to-cook mixes we all know. Then, you head over to Kerala, and it's Eastern's kingdom. They hold an unbelievable 42% of the market there, especially with their pure spices. So, you see, this isn't about being number one everywhere. It's about being the undisputed champion in key high-value regions, and that is their big competitive moat.
And if you're wondering just how dominant they really are, check this out. 9 out of 10. In their home turfs of Karnataka and Kerala, their products are in 9 out of every 10 households. I mean, just think about that. That's a level of market penetration and brand loyalty that is incredibly, incredibly hard for any competitor to even think about challenging.
Okay, so we've established the brands are rock solid and they own their markets, but does that translate to a healthy business? Let's follow the money trail and see what the financials tell us.
All right, let's look at the numbers. On the surface, the revenue looks great, right? It's climbing steadily year over year. But take a look at the profit. That's where things get interesting. See that dip in fiscal 2024? The profit dropped before it started to recover. Now that's the kind of thing that should make any investor pause and ask, what happened? Was this just a temporary blip, like a spike in raw material costs? Or is there something else going on under the hood?
So, how do we get a better sense of the trend without getting distracted by that one-year dip? Well, we use a handy little metric called ROACCAGR. Now, don't let the alphabet soup scare you. All it does is calculate the average, smooth annual growth in profits over a couple of years. It basically irons out the volatility so we can see the bigger picture.
And what does that bigger picture look like? Well, here it is, 39%. When you smooth things out, their profit grew at an average annual rate of 39% between 2022 and 2024. Now, let me tell you, in the packaged foods industry, that is a really impressive number. It actually makes them the second fastest growing company among their main competitors. So despite that one dip, the underlying growth engine here seems pretty powerful.
Okay, but a great company is one thing. It's also about the playground they're in. So let's zoom out and look at the market and the competition. Where does Orkla India actually fit in?
And the first piece of good news for them is that they're playing in a market that's absolutely booming. The Indian packaged food market is growing, and it's projected to get a whole lot bigger by 2027. This is what we call a strong tailwind. It's like a rising tide that lifts all boats, meaning there's a ton of opportunity for everyone in this space to grow.
So, in this growing market, how does Orkla actually stack up against its rivals? Well, you can think of it like this. You've got your big national players and your smaller niche specialists. Orkla's strategy is different. They are the undisputed kings of the South. While others spread themselves thin across the country, Orkla has built a fortress in its core markets, giving them this incredible, concentrated power.
All right, we've looked at the business, the money, and the market. It's time to put it all together. Let's get to the final verdict, the pros and the cons.
So, let's lay it all out. The pros are pretty clear, right? You've got that market leadership in the South, brands that are practically household names, a fantastic distribution network, and the backing of a big international company. But then you look at the risks. Raw material costs, like spices, can be super volatile. Their success is also very heavily tied to just a couple of states, and competition is always fierce. But there's one more really big risk factor on this list, and it has to do with the IPO itself. The whole thing is an offer for sale.
And what exactly does that mean? Well, an offer for sale, or OFS, is pretty different from a typical IPO. See, the money you're paying for your shares, it isn't going into the company to build new factories or launch new products. Nope, it's going directly into the pockets of the existing owners who are selling their shares. So you're not funding future growth, you're just buying out a piece from the current shareholders.
And that, my friends, leads us to the absolute heart of the matter. We have a stable business with fantastic brands. But since your money isn't going into the company to fuel its growth, the entire decision comes down to one thing: the price. Is this IPO being offered at a valuation that still leaves room for you, the new investor, to make money? That is the fundamental question you have to answer for yourself.
And just as a final reminder, please remember that this is all for informational purposes. It's not financial advice. Everything we've discussed is based on the company's official filings, so it's absolutely crucial that you do your own homework or talk to a professional advisor before making any investment decisions. All right? Great.